All right, so today I wanted to talk about what is, in my opinion, the easiest way to beat the market. And that is simply by selling covered calls on the market tracking broad-based ETFs, like the SPY, VOO, QQQ. Um, Now, there is one caveat to this. To sell options, you need 100 shares of the underlying index or stock, right? So if we go into QQQ here, let's just show it. Any platform, virtually any platform is going to be able to do this. Again, you look at the options chains here, right? So let's just go about a month. The third Friday of every month is going to be the one with the most liquidity because that's the one that any stock. A lot of stocks have just monthly options expirations, and if they do, it'll be on the third Friday of every month. So that's always the one that's going to have the most liquidity. And again, if you look at like a QQQ, there's a crazy amount of liquidity, um, and that brings me to the point to where it becomes fairly controversial in um, how far out of the money do you sell the calls? Because this is the real question here. Because if you sell too close to in the money, let's say 305 here, it's going to be a lot more likely that the option expires in the money, which means you're going to the person that you sold the option to is going to call the shares away from you, right? So in my opinion, what I would do is sell quite a ways out of the money, right? I would sell probably with like a 10 or a 20 beta, meaning there's about a 10 to 20% chance that the calls are going to end up in the money. The problem with that is that the lower the beta, the lower the premium you're going to get. So the premium is the amount of money that you collect for selling the shares, right? So it's this number right here, right? Um, so again, the further out of the money you go, meaning the higher the price of the index or the stock, the lower you're going to get because it's less likely that it's going to end up in the money, right? So that's where the tightrope comes in, right? The tightrope comes in when it comes to selling options. How far out of the money do you sell? A lot of people when you first get into it, I fell into this trap as well, and it's still tempting. Is you want to sell closer to being in the money because you get a higher premium. The problem with that is that you end up a lot more likely with those shares ending up in the money, and not only that, you end up with being more likely to lose capital, right? Because if you sell the 310 call and the stock ends up at 320, you miss all of that upside between 310 and 320. You still get out looking pretty good, but you do lose some of the upside. So the further out you sell, the more upside you can capture, right? And if you want to beat the market, in my opinion, you have to sell quite a ways out of the money. What I would do is simply sell to the point to where you literally get an extra 2 or 3% a year, right? You want to just add just that little bit so it gives you a cushion. And again, what a lot of people don't realize is that selling, or sorry, making an extra 1 or 2% a year over the matter of like 30 years, that is a very, 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 very large difference. That is literally a matter of hundreds of thousands of dollars, potentially even upwards of like $1 million, depending on how much you're investing a month. So if you can return an extra 1 or 2% per year, that is all that I'm trying to do personally. And obviously, I want more. If I can get 5% more, 10% more, by all means. But over the period of 30 years, it's never going to happen, right? You'd be the best investor of all time if you did that, right? All you want to do is just beat the market by a little bit, 1, 2, 3%. And it's actually, in my opinion, because there is definitely some guesswork in there. There's quite a bit that goes into it. It is selling those covered calls, and not only that, um, it gives you that extra income to reinvest, right? Um, the one caveat too is if you're new and you want to sell in the QQQs, you're going to need about $30,000, right? So that's a lot of money. If you want some that are a little bit lower, there's RSP, which is the equal weight S&P index. That's one of the ones I like. SCHD is even lower yet. This is a dividend growth fund. That one's at about 76. So you'd need about $7,700 to start selling covered calls on this. And again, like I mentioned earlier, the beauty of this strategy too is that you capture virtually all the upside if you're doing it correctly. And on top of that, you're collecting premium that you can use to reinvest into more shares of the existing ETF or stock, or what I do is use it to buy into other ones so you can diversify, right? Um, so I just wanted to make a video about this, is that I don't think it's that hard to beat the market, because if you're doing this, honestly, it's pretty hard not to beat the market. The problem comes in is making sure you're selling in an appropriate way. And another very important thing will come up also that we would have seen over the last year if you were doing this, is what happens when you buy shares and it goes down like 20%. Because then it'll probably be at the point where you can't sell at a point to where it will be at or above your cost basis. There's kind of two options. You can sell below your cost basis and risk it, or you can sell way out of the money, or way down the road. You can sell like a year down the road, but the problem with that is that you could lose a lot of upside, or you could just hold the shares. In my opinion, I would evaluate the market. I don't think there's any one size fits all. Because markets are going to go through ups and downs. If you're in a major bear market, I would probably just wait until you get a bounce up and then sell, right? But again, that's just my opinion. That is that is the other very important thing, and that's something you're going to see. Now, when you're in a very clear bull market, you need to be selling further out of the money. When you're in a clear bear market, I think you can afford to sell a little more closer to the money, because again, it's a bear market. The chances of things going up is a lot lower. But again, it is a tightrope, right? Because when you have bear markets and bull markets, it doesn't go up in a straight line. It doesn't go down in a straight line. So you have to be very careful. You have to be paying attention very close, right? So again, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.